All right. And now Ed Butowsky, Wealth Wizard, joins us to give us his outlook for the markets and the economy in 2023. We appreciate your being here, Ed. Ed and I worked on the book that he put out called Wealth Mismanagement, in which this 20-year veteran of Wall Street big firms, Ed says that Wall Street's kind of bad at managing risk. See the FTX collapse in crypto that he talked with us about in a recent episode. So, Ed, it was one of the most horrible years for stocks, certainly the worst since 2008. The S&P 500 down, 20%? The NASDAQ down 33%. Is the pain over?
Well, I'll tell you, the pain, I believe, is over, but I think that it's going to be a slow process to recover. And the reason I say that is that Wall Street looks for clarity, and they look for clarity on earnings and interest rates. That's the key to how stocks are priced. And I believe that as we get into the first quarter, somewhere around the second half of the first quarter, I actually put out March the 6th, just as a date where I think things are going to start to turn around. So watch and see if that happens.
And why'd you pick March 6th?
Because stocks move 6 to 9 months ahead of earnings and economic data. And I believe we're going to have clarity on where earnings are going to be, because interest rates are going to be, we're going to be able to identify where interest rates are going to go, and that'll be priced into the overall stock market. So I believe we're going to see the Fed fund rate go up to about 5%. And stay there.
Only another half a point raise, really, in that case, before they then stop.
Yeah, I believe so. I think we're going to start to see inflation number comes down quite a bit. And that's going to give companies the ability to have clarity on and prediction on where they're going to spend their money and how much things are going to cost. And once Wall Street gets clarity on things, then they can start pricing it accordingly. So that's what I believe. I believe 2023 is going to be a much better year than 2022.
Sure, that's for sure. Now, we lost $12 trillion in collective stock value, and $3 trillion of that was just from those big five big tech stocks, the FANG, right? We've got Facebook, Meta down 64% in 2022, Netflix down 50%. The other three, Apple, Amazon, Google down 27% or more. And so it seems like we're being offered a chance to buy some of the glamour stocks at a real discount here, unless those companies are over. So what do you think about the FANG, just as a little sidelight there, on those stocks having lost this much value? Does your optimism extend to them?
It does. I actually believe the large cap, which are big company growth companies, those are companies that don't pay really nice dividends, but are really big and they're growth oriented. So for those of you who are listening, you have to remember that a value stock, if you took the sum of the parts and broke it up, the company is worth more than the sum of the parts. And that's why you have a value stock. Growth stocks are betting on future growth and earnings. So, and I believe Amazon and Apple and Google and Facebook, Netflix and so on, and Microsoft are going to do very well. I threw Microsoft in there as a FANG, but so it kind of plays in that bucket as well.
Ed, this is the most bullish and optimistic that I've heard you in a long time. And in the past year, the Russell 3000 Value Index. And value is, slower growing companies and not the hot tech glamour stuff. That did 20 percentage points better than the Russell 3000 Growth Index for 2022. And so you're kind of looking for more of a reversal at a time when, Goldman Sachs is thinking that the S&P 500, that index of the 500 largest companies, that it rises maybe 4% total in 2023 is their forecast. What would your number be by comparison with 4%?
I'm just throwing it out there. I think we're going to see about a 10% rise in the S&P this year. And that's going to come as a result of clarity on earnings. Again, Goldman Sachs is a huge firm, really, really smart people. And I'm sure they have a lot of statistics to back up with what they're saying. Mine's real simple. I think we're going to have clarity on where interest rates are. We're going to have clarity on earnings growth. And even though the stock market's still expensive now, I think it's going to start to grow into this.
Okay. Now, of course, everything relies on the Fed. The whole reason the market started falling apart, I think it was in November of 2021 is when the highs were reached for many of these biggest stocks, and everything started falling apart as the Fed raised rates, the equivalent of, 13-fold from, a quarter point all the way up to 4.5%, an amazingly jarring impact on business. We had 30,000 layoffs at big tech, but we had over 100,000 layoffs, it turns out, at startups, where VCs suddenly put on the brakes and instead of telling them to grow at any cost, suddenly change the entire thing. This is going to have kind of long-term dampening effects on economic growth if we aren't careful and go too far. Now, the Fed, though, they can't afford to raise rates for much longer, can they?
Well, they can afford to. I mean, they can do it, and their goal is to get inflation down to 2%, which is going to be a Herculean effort. But I believe we're going to start to see that trend. And remember, on Wall Street, the genius of investing is recognizing the direction of trends. Right. So if you see a trend where you start to see clarity on earnings and interest rates starting to drop, believe it or not, I think towards the end of 2023, we're going to see a drop in interest rates on the short end.
Well, yeah, they're going to come back down. They're overdoing it already. And by the way, talk about the outlook for recession. We just saw a story break where 23 economists, the economists at 23 different banks that do business with the Fed, are bracing for a recession this year. And of course, it's self-defined. I mean, the Fed's going to make it happen at all costs. And yet we're surviving so far. Christmas sales were up 7%, Visa said. And consumers haven't gotten the message, haven't gotten the memo.
I'll tell you, there's this old thing about Wall Street that, they did a survey of about 100 different economists on where interest rates would be 6 months later. They do this 2 times a year, and they almost always miss, by about 80%, miss the direction of interest rates, let alone where interest rates are going to be. So I'm again, these people are very, very smart, but I think I got this one nailed. I really do. I think March 6th is going to be the low point. And we're going to see things start to change then. And you asked why. And again, it's because of clarity, because people are going to start to get an idea of what the first quarter numbers are going to look like. And that's going to lead into the second and then third quarter. And we're going to have a really good year, I believe.
Yeah, if anything, expectations have been dampened down, tamped down sufficiently by the Fed to where there is a room for a surprise upside here. Now, in terms of sectors, energy had great time in 2022. Does energy continue to do well in 2023, do you think?
Yeah, and that's the one thing, that people might take fault on me for saying, because I do believe energy prices are going to go higher. There's such a demand for energy that the supply is not out there. And as long as they're playing games with, how much oil is being produced, we're going to probably see higher prices on gas and oil. But a lot of that is already baked into the market. So again, you have to remember what's already baked into the market and what are they forecasting, because the market is a great discounter of future events. And they've already discounted higher energy prices.
And it's discounted the recession, it seems like, which they're already braced for that. And
but I don't think we're going to have a recession. I think
really?
Yeah, I think we're going to be able to, if you look at how they play with those numbers, and the recession is 2 consecutive quarters of negative GDP growth.
Right.
We'd have to have the fourth quarter negative and the first quarter negative. And I don't believe the fourth quarter is going to be a negative GDP. That doesn't mean we're going to have a robust economy, but I just don't believe we're going to have a technical recession.
Well, everyone believes that the Fed watches GDP growth, and the GDP growth is a measurement of recession. In fact, the Fed is far more concerned about employment and unemployment. And when you look, I think the latest numbers are something like 11 million job openings, 250,000 new jobs in November, unemployment rate below 4%. You just don't see recession in those job numbers.
Right. Yeah. And I'm kind of a right-leaning person, but I will tell you that, a typical right-leaning person would just throw everything out there and say everything's terrible. But I'm very realistic as to what I believe. And I truly believe that we're going to see a pretty good market towards the second half of 2023. Okay.
And now let's turn quickly to bonds, because you're not a fan of bonds overall. And that U.S. bond index fell 13% in 2022. And that's compared with the steepest drop for that bond index. When you go take prices back to the 70s, I read somewhere was left like 3% in 1994. It fell 13%. You pointed out last time you were on with us you said that this is also the first time ever that it had fallen more than 10% along with stock prices. Instead of usually, guys, bond prices should go up when stock prices fall. That's why we have bonds in our portfolio. So what do you think is the outlook for bonds in 2023?
Well, I'll tell you, if you took for 2022, if you looked at the 60-40 split, the 60% equities, 40% bonds, that index was down 17%. That's the worst it's ever been down, that 60-40.
Together, yeah.
But I will tell you that I do believe that we're going to see a compression from the high yield side, where we're going to start to see those rates come lower, and we're going to, kind of see this reverse inverted curve start to change. So I think you're going to start to see the lower end of the market go down towards the end of 2024, and the 10-year is probably going to stay right about where it's at, but it's not going to be an inverted yield curve.
By that, the inverted yield curve, you mean lately, because the Fed's been raising interest rates, the interest rates on short-term bonds or treasuries, like the 2-year, have been actually higher on an annual basis than the rates paid on 30-year bonds or 10-year bonds, right?
Yeah, they went from about 25 basis points what they were paying, or on the very short end, to about 4%. So you said a 13 times move. It was a dramatic shift in terms of what people were getting paid for those bonds. But you have to remember that if you owned a bond that was paying you 1%, and then that same bond went up to be paying 3% on new issues, that 1% bond was worth a lot less. It was worth about 30% less.
Right.
So bonds are a very tricky thing. They're much more volatile than stocks. A lot of people don't realize that, but they are.
Right. Okay. I think this is just a really good, encouraging take on the new year at a time when so many others out there are preaching a bit of doom and recession and reduced expectations. And I'm so glad to hear it from you, Ed Butowsky of Chapwood Investments. And I do appreciate your being here. Before we let you go, do you have any couple of specifics? Now, last time you came up with some exotic stuff, but if you could go a little more mainstream on, well, right now, if you had a little bit of money to put someplace, where you'd be putting it, given your rather bullish outlook for 2023?
Yeah, I would be putting it into large cap growth index. There's something called FNGU, which is a very, very risky way of investing in the FANGs. What it does is it breaks down the top 10 technology stocks, large cap, and breaks them into 10 different buckets. So there's 10 different stocks there, and it's leveraged 3-to-1. So if you're really into taking, if you believe what I say about large cap growth, you want to buy FNGU.
All right, although it's a quite risky move to do.
That's right, but I'm putting it out there, Dennis.
You should do it like you're betting at the roulette wheel, guys, and bet black 31. It's my favorite roulette wheel bet. I've hit on it 3 times out of maybe 10. That's so. And remember, whatever you invest in is on you guys, and is your responsibility. Ed Butowsky of Chapwood Investments out there in Plano, Texas. I'm so glad you joined us today. Thank you, and have a glorious new year, and I'll be talking to you soon.
You too. Thanks, Dennis.